afternoon, everyone, and thank you for attending today's webinar on investment options within superannuation. We'll just give everyone a few short moments to join the webinar and we will commence shortly. Lots of people joining us today, which is great. All right, let's kick off. My name's Michelle Seguera and I'm a member account manager with Brighter Super. An important part of my role is guiding our valued members towards a comfortable retirement and giving them a better understanding of our superannuation accounts. Not surprisingly, one of the things that I get asked most about is investment options available. And by the end of this webinar, hopefully we'll aim to give you some useful information to help you understand your options. I will be asking some questions as we go through the webinar today to help you get a bit of understanding of the content. But before we get things underway, Brighter Super acknowledges the traditional owners of the lands on which we're meeting today, and we do pay our respects to the elders past, present, and emerging. We acknowledge and celebrate the continuation of a living culture that has a unique role within the region. Thank you. It is important to understand that the information and examples contained in the presentation today are general in nature and have been prepared without taking into account your individual objectives, financial situations, or needs. It is also important when making decisions about your super options that you obtain the relevant product disclosure statement, or PDS, and target market determination and consider your own personal circumstances. You can access these documents and the Financial Services Guide from the Brighter Super website, brightersuper.com.au. Today's presentation will run for about 30 minutes. Many of you have actually submitted questions already, which we have tried to incorporate into the presentation today. You can also post questions in the question and answer feature during the presentation, and we'll aim to answer those questions with you directly. So before we move on to our main subject, I'd like to take the opportunity to briefly explain who Brighter Super is, as we do have some non-members joining us today. The merger between LGIA Super, Energy Super, plus the acquisition of Suncorp Super has enabled us to increase our size and scale. Yet we do remain committed to investing in the personalised member service that you know, love and enjoy. We serve over 230,000 members with over 32 billion in funds under management. It's a lot. And we receive double digits returns for our balanced accumulation and balanced pension options for the year ending 30 June 2024. So let's talk superannuation investments. You are able to make a number of choices about your super, and one of the most important is deciding how your super is invested. The investment options you choose could make a big difference to your super earnings over time. There are various factors to consider when making your decisions though, and they include how long your money will be invested or the time frame, how comfortable you feel with volatility or your risk appetite, the level of return you expect, so your return expectation, and the other investments you have, which is also known as diversification, the amount of money you're also investing. One of the most useful pieces of information that a super fund sends to their members is their annual benefit statement, or ABS. The ABS contains important information such as contributions that we've made during a financial year, insurance that you may hold, any beneficiaries that may be on your account. And importantly, it also provides information about the investment option that a person may be in and the investment performance over the last financial year. If you're looking for information about what investment option you are in, the annual benefits statement is a great place to start. And the best place to review your ABS is via the member online portal. You're also able to get an email copy or a copy posted out to you. But if you're also unavailable to access online, you can call our service centre. So now that we're able to find what investment option you might be in, let's take a higher level view at what investment options may be available within superannuation. Some people think of their super as a single asset, but it can potentially be invested in many different assets. Most super funds offer different types of investment choices to their members. An investment choice is selecting which asset class you're invested in, such as Australian shares, international shares, fixed interest, cash, or property. They may be familiar to you. Investment options offered by super funds can either be diversified, which means investing in a mix of different asset classes, or single sector options, investing in just one. Diversification can be also achieved by choosing ready-made diversified options such as growth or balanced investment options, or by choosing a mix of single sector options, choosing your own mix of different asset classes rather than a ready-made mix. Let's do our first poll. So everybody looking at the screen, do you know which investment option you are in? Oh, it's looking good. Fantastic. That's great, everybody. Looking all over your investment options, which is fantastic. 73%, I think we've reached there. Fantastic. Assets such as equities, other known as shares, are described as growth assets. These may see volatility over the short term, and the value may go up and down. But over the long-term periods, they generally experience high growth. Asset classes like cash and fixed interest are sometimes described as defensive options. They carry less risk in terms of volatility of returns and the potential for capital loss, but they also offer less potential for high returns. These options are generally described as low risk and low return. Ready-made diversified options are made up of different mixes of growth and defensive assets classes. Investment options vary from fund to fund. Some super funds define their investment options in terms of their risk characteristics, such as growth or balanced strategies. Other funds offer more specialist options, such as strategies that offer socially responsible investment approaches. Other funds let members have greater control over selecting underlying investments, such as choosing mostly shares. You don't have to make an investment choice. If you choose not to, your money will be invested in a fund's default investment option. And for Brighter Super, that option is called our My Super option. And depending on your personal time frame, risk appetite, return expectation, this may not be the right option for you. It's important to understand that everyone's personal situation is different, and everyone's attitude to risk and return is also different, or can be different. For details on what investment option you may be with in Brighter Super, you can check your annual statement, your member online account, or call the service centre for more information. So this next slide, you may have heard the phrase on TV, past performance is not an indicator of future performance. I'll say that again for you. Past performance is not an indicator of future performance. And when hearing super funds talk about their returns, this isn't just something that they absolve themselves of any responsibility. It's actually a really important thing to remember. Lots of boxes on this screen. One of my favourite slides we use in our presentation, and it actually shows the performance of 8 different asset classes over 19 years. For the purpose of the presentation today, it's not the asset classes themselves that's important. It's their performance over time. So as you can see, there's not one asset class here that consistently outperformed another. I think most striking feature in this chart is that over a period, different asset classes have performed very differently. Some of the best performers one year may not be so good the following year. Once again, you may have heard the phrase, past performance is not a reliable indicator of past performance. And through this table, we can see what's meant by that. And this is why super funds may look at taking a diversified option when it comes to investing. By spreading the funds across different asset classes, they can balance their volatility and the returns, and by also spreading the risk, basically not putting all their eggs in one basket. This next slide, the white boxes you can see on your screen there are a diversified portfolio. That is, it's a mix of different asset classes. So we can see that by diversifying an investment option and by making a mix of different asset classes, it smoothed out the peaks and the troughs of a single asset class and provides less volatile investment choice. Diversified investment options take different mixes of the single asset classes in different proportions, and they create a mix that may be growth or defensive orientated investment choices. Another consideration that people should take into account when choosing their investment options is the time frame you have. How long they'll be leaving their funds invested for, how long they'll be invested for before they need to access those funds. Everybody's time frame is different, just as everybody's attitude towards risk is also different. I'm going to hand over to Stephen now. Off you go, Stephen.
Thanks,
you.
Michelle. My name is Stephen Wright. I'm one of the financial advisors here at Brighter Super, and today I'm going to talk you through some of the tools we have available to help you, to assist you when making some of your investment decisions. So often when I'm talking to people about investment choice, they ask the question, what is the best way to invest my super? And as you can imagine, there's not one single investment option that's going to fit everybody. Right. In fact, there's a number of different considerations when choosing the right risk profile for you. So the other question I get is, what exactly is a risk profile? So a risk profile is an individual measure of how you will feel about risk and return, and keeping in mind that there is a trade-off between the two. It takes into account your tolerance for market falls, but as well as your investment time frame and your desired return outcomes. In a perfect world, we would all love high returns without any falls. However, generally speaking, the more risk you take on, the better returns you're going to get over the longer term, but also the greater swings you're going to get along the way and the more chance of a negative return. So, for example, as an aggressive investor, it's expected that you'll generate higher returns over the longer term. However, it does mean that your balance will fluctuate more when market does start to jump around a little bit. And it means that your investments it'll generate greater returns over the longer return, but it'll also mean you could lose slightly more when the market does dip, and the more chance of negative returns through each years. The trade-off to that is a more conservative investor, on the other hand, is that you will get fewer negative returns and your balance won't jump around as much as what it may do as an aggressive investor, but there is a trade-off. The more conservative you go, the lower the returns you're expected to go over the longer term. Understanding your risk profile is important to help you prepare for when the market does become volatile and move around a little bit. The risk of being invested outside your risk profile, if you're invested too conservative, then you may be leaving some returns on the table or not get as good a returns as what you might get. If you're invested too aggressive, then it may work out well when the market's doing well, but it may drop a lot more than what you're comfortable with when we do get that market volatility at the end of the day. And I guess it's a trade-off between the two. You need to work out what the best optimal outcome is for you in your individual circumstances. As a starting point, if we're trying to work out what we're doing, as a starting point, you can find an investment risk profile on the on the Brighter Super website. From memory, it's in the top right-hand corner. It'll ask you 8 questions. How do you feel about negative returns? What action would you take if there was some market instability, if it was going up and going down? What's your goals? And after you answer each question, it will then provide you with a result and some more information on that result based on your responses. When you answer the questions, I would just encourage you to see the bigger picture, because when someone asks us about how they feel about negative returns, we're not all the same. And none of us like to see negative returns, but it is important to understand what's your investment time frame as well at the end of the day. So, for example, if you're in your 40s and you've still got 20 years away from being able to access your super, a negative return may feel a lot different to someone that's in their 60s and they're thinking about retiring in the next year or two. However, it is important to note that even as you get closer to retirement, your investment timeframe still may be longer than what you think. Yes, your working life is shortening up, but if you're going to leave the money in the super environment until you're 70, 80, and 90 and draw little bits out each time, then you still probably may have an investment timeframe of 20 to 30 years to be thinking about as well. Okay. Once you've completed the risk profile questionnaire, it will provide you with information about your profile, what it means, and that sort of thing. And it's important to note, though, it doesn't give you an investment recommendation for your super. It's just information saying, all right, an aggressive risk profile, this is what it means, and some more information. If you wish to receive some specific advice about how you should be invested, I encourage you to book an appointment with one of our intra-fund advice team. This type of advice is included in your membership, and it's normally done over the phone, takes about 20 to 40 minutes, and the advisor will then they'll ask you similar questions to the risk profile questionnaire, but they can also give you a bit of background, explain what the questions mean a little bit more, answer any questions along the way for you as well. So any information, once that process is complete, the advisor will give you a formal recommendation. They'll tell you how to invest that money. They'll put it in a written document called a statement of advice, which gives you all the risks and the benefits of that recommendation, and any changes in fees and profiles and all that sort of stuff as well. All right, this might be a good opportunity to do a next poll question. So is anybody on the line, have they used an investment advice service before? Okay, a bit of a mix there. That's good. So about 40% of the people saying yes, and about 60% no. So interesting. Okay, for those who might know, we do offer age of personal advice here at Brighter Super that can suit your individual needs. If you're looking for specific information about contributions or investment strategies, our intra-fund advice team can help there. And there's no additional cost for that. It's included in your Brighter membership, in your Brighter membership fees. We also offer more comprehensive personal advice, which we can discuss in more detail after this presentation, or later in the presentation. Okay, so we also have some tools on our website that model your retirement and how you're tracking towards your retirement goal. As with all modeling tools, it's based on metrics that may change over time, so we cannot use this as a matter of fact. However, it does help provide some estimates on how you are tracking towards your retirement. Depending on what level of assets you have and how much you have, you need to fund your desired retirement lifestyle. You may only need to invest your funds in a much lower risk profile. On the other hand, if the opposite's true, you may need to reevaluate how much you need to live off, or other metrics moving forward. For most people, I talk to, they still need to take on some risk over the longer term to achieve their retirement outcome. There is an option to toggle both for your pre-retirement and post-retirement investment options, and you can play around with that kind of difference you can play around with that to see what kind of difference it makes at the end of the day. If you're getting closer to retirement, particular if you're already over the age of 60, it may be worthwhile getting in touch with a financial advisor to discuss your pre-retirement strategies, and that may assist in your meeting your retirement goals as well. So we are able to tailor your investments to your individual circumstances and make sure that your investments are right for you at the end of the day. For this type of service, it's called comprehensive advice. We do not charge an advice fee initially. So this provides advice to members and non-members about investments within the fund and some external investments outside super as well. This advice also encompasses your spouse, your partner's situation. This type of advice is usually most helpful when you're achieving a milestone, i.e. you're 60, 65, getting to pension age or something like that, or if you're starting to think more seriously about retirement and those sort of things as well. So thank you for your time. I'll hand you back to Michelle.
Thanks, Stephen. That was great. As discussed before, everybody's different. There are lots of information that can be had. So how do we achieve a consistent return for such a wide range of our members? We do this by identifying investment opportunities that possess the following characteristics. Insulation from volatility. So while no investment is risk-free, a diversified approach seeks to minimise the impact of market instability. By including assets, we have regular returns over a period of time that enables us to smooth out some volatility. Innovative directive investments. These include unique projects and infrastructure assets with a strong market share or with a monopoly. Airports are a really great example of this, and also tangible assets that benefit the entire community. For example, an example of this would be the regional livestock exchange that we have throughout Queensland. So you can see on your slide some real assets here that Brighter Super has invested in, and this is just showing you just the ones in Queensland. So we can see that there's a lot to take into account when considering investment options. It can be quite intimidating. It's a lot of information. It can be a little overwhelming to think about. But the good news here is that help is available here from Brighter Super. So I was being a little bit selfish before. I didn't introduce Kelly, who is our moderator sitting in the background. And I guess one of the things, she's been with us for 8 years. So we've got Kelly on the screen now. I think we can see Kelly. There she is. So one of the things, what makes Brighter Super different to other super funds, it's our commitment to personal service. We do have a dedicated team of member account specialists here to support you. And if you'd like to talk to one of our staff one-on-one for a more general information about your super, why not book in for a super health check? Super health checks are 15-minute meetings. They're at no additional cost and cover a range of topics about your super, not just investments. Our team service members all over Queensland with face-to-face services and also digital channels or virtual options. So you can get some general advice on a range of superannuation topics, no matter where you live or where you work. Once you've got the general knowledge, the next steps get to run through that personal advice, which Steve touched on before. So I'll hand back over to Steve to run through these.
Thank you. So yeah, there is lots of great information on the website and different avenues to get general advice and just learn a little bit more. But we do offer a range of personal advice options that can give you individual recommendations really at the end of the day as well. So if you're looking for some specific information about making contributions or investments, that sort of thing, then that can be done as part of by our intra-fund advice team. As discussed, it's normally done on the phone, generally takes about 30, 40 minutes, and there's no additional cost to you. It just forms part of your membership fees really at the end of the day. I guess some of the most common questions I get when I am talking to people is, how much super do I need to retire? And do I have enough retirement? Do I have enough in the kitty to retire on? And if you're looking to sort of gain the answers to those questions, then we do offer what we call a retirement health check. It's a projection really at the end of the day, and we sit through, get your assets and liabilities, and talk you through the result of that projection and how long your money's going to last, and then can also maybe suggest some ways to improve your situation if need to as well. If we're looking for a little bit more than just a projection really at the end of the day, and we're after some more specific options, then we offer a couple of different investment options. The first one is the scaled option. So more just cut down, just looking for more specific recommendations on just one or two topics at the end of the day. And then we do offer comprehensive advice as well. So this service takes into account your whole financial situation, and we can give you tailored advice based on your individual needs and specifically what's best for you. Typically, this meeting will be face-to-face if and we do offer these in Brisbane and various regional areas around Queensland, but we can also do them via Zoom and other digital channels if need be as well. So the cost will depend on the complexity of the advice. So, but generally it can be deducted out of your account really at the end of the day. So we're a fee for service. If it's a nice, easy transaction, then the cost tends to be a little bit less. If you are more complex or there's more work involved, then it can be a little bit, then the price may go up from there at the end of the day. But I guess it never hurts to ask the question. It's never too early to ask the question to get personal advice and get you started on the right track about what's actually better for you at the end of the day. Thanks, Michelle.
Thanks, Stephen. Similar to today's webinar, our seminar webinar webpage includes a range of upcoming webinar topics just like this one. Keep an eye on the page as we update it regularly. If you register for any webinars, regardless of whether you attend, you will receive a copy of the recording the day following the webinar. So on the previous two slides, we discussed a range of advice services, and these cover the super health checks, the intra-fund advice, both of which are no additional cost to our members. And the other types of the advice that Stephen mentions was the retirement health check, the scaled and comprehensive advice, which are a fee for service. Our next poll question is over to you. So I have a look at that question on your screen. After today's webinar and the information that you've taken, would you be open or planning to get some advice? Fantastic. We're looking at a really even split here so far. Yeah, really even split. Okay. So we're looking at, 56% of you would love to get some advice, which is really great. Investing in that future is something that you'll thank yourself for later. So I guess we've covered a lot of ground today and a lot of information. And you can also visit the resources information tab on our website. If you follow that and go to forms and information sheets on the website for more information on the different forms that we've discussed today, there's also some handy information sheets for your reading pleasure. On that note, I will bring that magic person back, Kelly, I'll hand you over to Kelly to see, and I'll ask Kelly to facilitate our question and answer session. And I'll also invite Steve. Steve's back on the screen to join us as well. So during the Q&A, we'll also put the health check slide back on to give you some additional time. So if you wish to book in an appointment, you can do that as well. So over to you, Kelly. Thank you.
Thanks, Michelle, and thanks, Stephen, as well. That was a great presentation, and I hope everyone listening has picked up something new from today's session. I haven't had any questions come through the chat today, guys, so if you do have any questions that you'd like to pop in there now, please do so. I do have a couple of pre-submitted questions, though, so I will take this opportunity to ask them. I do have one that came through from Michelle, not our Michelle, one of our members, who's asking, how can I best protect my super from major drops as I get near retirement? And I'd love to pass this question on to Steve, who's been chatting about our advice services. I'll let him take that away.
Perfect, thank you. So still generally speaking, there's a couple of different things you can talk about. So as people get closer to retirement, it is still important that they do take on some risk to continue to grow their super. We still need to get that growth to have as much as we can when we do finally decide to retire. Some people will continue in the same investment option, but some people may decide to take that one little step down to still try and get some half decent returns and still keep it growing, but maybe take some of that risk off the table as well. So you may leave a little bit of return on the table, but you won't potentially get the bigger ups or the bigger downs along the way. As mentioned previously, I think I talk to lots of people, and yes, their working life is shortening up. So as they get 60s, they're not working, they're not going to work forever. But as I mentioned, if you're going to leave the money in the super environment when you're 70, 80, and 90, then we probably don't want to ride the huge ups and downs that a 20-year-old does, but we do still have a long investment time frame. So we still do need to take on some risk, but it may be worthwhile taking a step down as we get closer. But it is also it's based on your individual circumstances and that sort of thing as well.
Great, thanks, Stephen. Really appreciate answering that question today. I have noticed that another question has popped in, but I might answer that one directly because we have just come over time and I don't want to go too far over time. So I'm just going to hand back to Michelle. Thank you.
Thank you very much. Thanks, Stephen, and thanks, Kelly. Just a final question for everyone before we wrap up. We just want to know, how satisfied were you today with today's webinar and the topic at hand? So if you can answer that, that would be fantastic. Just give everyone a bit of time. Excellent. Well, thank you very much for answering all our questions and being online with us today. We hope you've taken away a couple of gems, or maybe thought about getting some advice in the future. So thanks again. Thank you, Kelly. Thank you, Steve. And we hope to speak to you soon. Goodbye.